This video is brought to you by the Seventh Monk. This is lecture 2 of Unit 5, Balance of Payments. So in the last lecture, we did foreign exchange rate along with its meaning and types, where we studied fixed, flexible and managed floating exchange rate along with its merits and demerits. After that, we did determination of exchange rate in a free market. Now we are left with this portion where we have to do balance of payments accounts, its meaning, components, balance of payments deficit, meaning, etc. Alright, so let's get started with understanding the meaning of balance of payments first. Balance of payments of a country is an annual statement for a financial year of all economic transactions between the residents of a country with rest of the world, that is other countries. Each country enters in the economic transaction with other country of the world, and balance of payments is a summary statement of accounts of such receipt and payment. All receipts and payment take place in foreign exchange. Alright. So over here you can see that a financial year starts from 1st of April and it is till 31st of March. Okay. So between that period of time, whatever economic transaction is happening between residents of the country and rest of the world is accounted in balance of payments. Okay. So let's derive the characteristics or features of balance of payments from the meaning that we had just studied. Since the first important keyword itself says that it is happening in a financial year, that is from 1st of April till 31st of March. So it is happening between 2 points of time, right? It is happening over 2 points of time. So it is a flow concept, right? While teaching you national income and related aggregates, there I told you the difference between stock and flow concept. Stock is anything that happens at a particular point of time. On the other hand, flow happens over a period of time, and financial year is over a period of time. That's why it is a flow concept. Balance of payments is a flow concept, right? And economic transactions are happening between whom? Between residents of the country with rest of the world, right? So its other characteristic says the same thing, that it takes place between residents of the country and the rest of the world, right? Coming to the third character, it says that it is a summary of international transactions between a country, and international transaction arises on account of flow of goods and services and capital. Okay, so economic transactions are arising because of flow of goods and services and capital. So this third key point is summarized by the third character. Alright, so if you have to write the characteristics or features of balance of payments, then just explain all the keywords in the meaning of balance of payments, that it is an annual financial statement for a financial year of all economic transactions between whom? Between residents of the country and rest of the world. Alright, so all the imports and exports that are happening of either goods and services, capital, income, everything are accounted in balance of payments. This term economic transactions is very important, so I want to discuss about it at some length. So let's discuss what economic transactions actually mean, right? Economic transactions in balance of payments consist of exports and imports of goods, visible item of trade, invisible item, services, unilateral transfers, capital transfers, and income from investment and work. Okay, so exports and imports of goods or visible items of trade include all type of physical goods that are exported and imported. These are called visible items because such goods can be seen, touched and measured and are duly recorded at custom barriers. Talking about the second component of economic transactions, it is invisible items or services. Okay, invisible items refers to all type of services that are given and received. Example, income from interest and dividend, shipping, banking, insurance, tourism. These are invisible items because services are not visible like physical goods. Okay. Then coming to unilateral transfers, some economic flows between nations also take place without any payment or transfer payment. For example, gift, remittance sent by immigrants to relative, war indemnitive paid by the defeated country, etc. Coming to the next component, it is capital transfers. These are related to capital receipts and capital payment. These include borrowing, capital repayment, sale of assets, change in stock of gold and reserves of foreign currency and foreign exchange, etc. And then we have income from investment in work. It includes profits, interest, dividend, etc. from investment, and salaries from work given abroad. Alright. Now there are two terms that are often confused with each other. These are balance of payments and balance of trade. See, balance of payment include economic transactions that is happening on account of all these five things. On the other hand, balance of trade only account for export and import of visible items good. Okay, so this balance of trade is just one component of the economic transactions that are happening in balance of payments. Okay, so if balance of trade is included with all these components, then it will form balance of payments, right? So balance of trade is a very narrow concept because it is just accounting for visible items. Alright, you already know what balance of payments is. It is a systematic record of all economic transactions of the country with rest of the world. On the other hand, balance of trade is just the difference between exports and imports of visible items. It is accounting all economic transactions, but balance of trade is accounting only visible items. Okay. Then balance of payments includes visible items, invisible items, unilateral transfers, capital transfers, all these things. But balance of trade is only including visible item. Hence, balance of payment is a wider concept and balance of trade is a narrow concept. Okay. So I hope that this is clear to you. In order to find balance of trade, what you will do, you have to just subtract exports of visible items from imports, right? Exports are entered as credit or positive items in balance of payments account as it corresponds to the inflow of foreign exchange, and imports are entered as debit or negative items in the balance of payments account as it corresponds with outflow of foreign exchange. Balance of trade is just a part of balance of payments account. Okay, it is favorable when exports are more than imports and it is unfavorable when imports are more than exports. Balance of trade is also known as balance of visible trade or trade balance. Okay, so if a question will come, okay, to differentiate between these two, I hope that you can now do that. Okay, now let's move further to the components of balance of payments. As per your syllabus, you can again see over here that first we have to do meaning and then components. So we are done with the meaning, right? We did it in very detailed way by deriving characteristics and features. Now we will do the components of balance of payments. While telling you about economic transaction, I told you that there are 5 components of economic transaction, right? Exports and imports of goods, invisible items, unilateral transfer, capital transfer, and income from investment and work, right? So there are 2 components of balance of payments, capital account and current account, right? Capital account includes capital transfer and rest all the other economic transactions are included in current account, right? So exports and imports of goods, visible items, invisible items, unilateral transfer, income from investment and work, these all are the components of current account. Okay, all are the components of current account, whereas only this capital transfer, this one is the component of capital account. So this alone is of capital account and rest all the other are from current account. Is that clear? So I hope that the difference between current account, the 2 components, is clear to you, what current accounts record and what capital account records. All right, now let's study about its meaning at some more detail. Okay, so talking about current account, it is an account which records all the transactions relating to exports and imports of goods and services and unilateral transfer during a given period of time. Okay, so that account which is recording exports and imports of all these 4 components is current account, right? So the components of current account are exports and imports of goods, that is visible item. Now you know what visible items are, right? And then exports and imports of services, that is invisible item. Okay, see, invisible item or non-material goods or services are the goods which are not visible, like the goods and services the goods that are visible. Okay, invisible items are services, right? And the examples of invisible items are transportation, services rendered by commercial undertakings, example shipping companies, banks, insurance companies, etc. Exports of services, then traveling, investment income, rent, interest, profit, then donation and gift, government embassies, right, which spend a lot of money in their maintenance, miscellaneous commission, advertisement, then royalty, patent fee, rent. These all are the part of invisible items, right? That is, all services are included in invisible items. Then we have unilateral transfer as other component of current account, and finally we have income. Okay, so income from investment, and then we have compensation of employees. Investment income and compensation of employees is accounted in income. So while talking about economic transaction, when I told income from investment and work, the income from work is called compensation of employees. All right. So now coming to the component of capital account, okay. Capital account record all those economic transactions between the residents of the country and the rest of the world which cause a change in assets or liabilities of the residents of the country or its government. Okay, so that account which is changing the assets or liabilities of residents or the government of the country is capital account. You notice that in current account there was no change in assets or liabilities, whereas capital account is changing assets as well as liabilities. For example, if you will borrow from someone, then there will be a liability on you. If you will lend to someone, that will be an asset for you. Okay, if you will do investment, that will be an asset for you. So capital account has such components as its part. Okay, it includes borrowing and lending, both private and official transaction, investment, foreign direct investment and portfolio investment, change in foreign exchange reserve, etc. are the components of capital account, right? Because it is related to assets and liabilities of financial nature. So let's do all these components at some length. So borrowing and lending involves transaction of loan. These may be private transaction. These affect assets and liabilities of non-government entities or private sector. For example, private sector of a country receives short-term and long-term foreign loans. Receipt of such loans are recorded as positive credit item and their repayment is recorded as negative or debit item of balance of payments. Then we have official transactions. These affect assets and liabilities status of government of a country. For example, government borrows loan from foreign government and international organizations to finance the deficit in the balance of payments. Receipts of such loans are recorded on the positive credit side and repayment of loans is recorded on the negative debit side. Then we have investment as a component of capital account. It involves transaction of investment. These may be private or official transactions. These are of two types. Foreign direct investment, it refers to purchase of an asset in the rest of the world which gives full control to the buyer over the asset. For example, acquisition of a foreign firm by ITC Limited. This investment is foreign direct investment as it gives direct and full control to the Indian firm over this asset. Okay. So purchase of assets abroad is recorded on the negative debit side and sale of assets abroad is recorded on the positive credit side of balance of payments. Remember that foreign direct investment gives full control to the buyer over the asset. On the other hand, portfolio investment is giving partial control, right? So when the difference between FDI and portfolio investment will come, I hope that you will be able to write it. Foreign direct investment is giving full control, right? It is giving full control over the asset, and the portfolio investment is giving only the partial control over the asset, right? So portfolio investment refers to purchase of an asset in the rest of the world which does not give full control over the asset. For example, purchase of share of a foreign firm by Tata Industry. Purchase of share of a foreign firm is portfolio investment by the Indian firm as it gives only partial control over the asset. And purchase of asset abroad will be recorded on the negative, that is debit side, and sale of the asset abroad will be recorded on the positive or the credit side of the balance of payments account. Alright. So remember, FDI gives full control and portfolio gives partial control. Now talking about the last component of capital account, it is change in foreign exchange reserves. Foreign exchange reserves are the financial assets of a country held by the central bank. This is what you already know, right? And then when addition to these reserves is made, it implies negative item. and entered in the debit side of balance of payments, and any withdrawal from these reserves is recorded on the positive or credit side of the balance of payment. So I hope that you are getting it. If these are your foreign exchange reserves, so when addition to these reserves is made, if you are adding something to these reserves, then this is government. See, this is government, right? And here are your foreign exchange reserves with RBI. Okay, so if there is addition to foreign exchange reserve, it will go from government to the accounts of RBI to the foreign exchange reserves that are there with RBI. So the addition of these reserves implies negative item and is entered on the debit side of balance of payment. It means something is going out from the hands of government, so it will be entered as a negative item. Okay, and any withdrawal from these reserves, if you're withdrawing anything from these reserves, then government will have more of it, so it will be entered as a positive item. So for here, just remember that your foreign exchange reserves are treated like foreign, like other nation. Okay, because a question might arise in your mind that since when we are doing addition, when there is addition to the reserve, it means government is having more because these reserves are of the government. Then why we are entering it like a negative item? Why not like a positive item? So over here, just remember a simple rule that these foreign exchange reserves are treated like a foreign nation. Okay, so the addition to these reserves is not treated like a positive item. It is treated like a negative item. Remember this point. Most of the children have confusion in this regard. So why I have made it very clear to you. All right, that whenever there will be addition to these reserves, it will be negative item and will be entered on debit side, and withdrawal will be recorded on positive or credit side of balance of payments. Now I think that all the components are clear to you, along with the further components of current account and capital account with their meaning. So please remember that these all things, because one question will surely come from this portion. It is very important. Now moving further, let's see what is the difference between current account and capital account in a clear-cut way. Over here, when I told you it was not that clear, but over here I'll tell you in a very clear-cut way the difference between these two. Okay, so first let's talk about its meaning. Over here I don't know why question mark has come, but here we are talking about meaning. Okay, so let's see what is the meaning of current account and what is the meaning of capital account. As I had earlier told you that capital accounts are causing change in assets or liabilities of the residents or the government, whereas current account are not changing assets and liabilities of the government, right? So from this is clear to you what current account are doing and what capital account are doing. So their meaning simply says current account records all those transactions between residents of the country and rest of the world that do not cause change in assets or liabilities of residents of the country and the government. And capital account records all transactions between residents of the country and rest of the world that causes change in assets or liabilities of the residents of the country or its government, right? And then talking about which type of concept it is. So current account is a flow concept because it is measured over a period of time, right? And capital account on the other hand is a stock concept. It is measured at a particular point of time. Now let's see about their change. Current account transactions bring change in investment level of the country. On the other hand, capital transactions bring about change in capital stock of the country. And then talking about their components, current account includes visible, invisible, unilateral transfer, income from investment and work, and capital account includes borrowing and lending, right? Both private and official transactions. Then foreign direct investment, portfolio investment, and change in foreign exchange reserves. Okay, so this is the difference between these two, and this question is often asked in the examination. So please remember all these differences, right? Now coming to the further part. Over here, if a question will come for calculating the current account balance or capital account balance, just use these formula. Now you know the components of current account balance, so you can simply use this formula by adding all the balance of all the components together, and by answering the question. Okay, we will practice such questions in the next part, right? In the next part of this lecture, where we will solve all the important questions that CBSE can ask. Okay, so if the question asks you to find current account balance, then you have to find the balance of visible trade plus balance of invisible trade plus balance of unilateral transfer plus income. And how we can find balance of all these things? See, balance means export minus import. So export minus import of visible trade plus export minus import of invisible trade, and so on. And if you have to find capital account balance, then just subtract capital receipt from capital payment. Okay, and these things will be given to you in the question. So we will practice it later on. Let's just focus on the conceptual things. So capital flow is further of two types: autonomous capital flow and accommodating capital flow. Now let's just discuss the difference between these two, because it is also often asked in the examination. See, there are two types of capital flow in the capital account: autonomous and accommodating. Autonomous capital flow are those international economic transactions which take place due to some economic motives, such as profit maximization. These are independent of other economic transactions in the balance of payments. Okay, so these are for profit maximization, autonomous. On the other hand, while talking about accommodating items, these are those transactions that are undertaken in order to maintain the balance in the balance of payments account, that is to bring equilibrium in inflow and outflow of goods. Okay, so over here you can see that first of all I have given the meaning of both the things. Autonomous are related to economic motives for profit maximization. On the other hand, accommodating are not related to profit maximization. Then autonomous items, these transactions do not maintain balance of payment identity. That is, these are not conditioned by positive or negative balance of payment status of the country. On the other hand, accommodating items maintain balance of payment identity. That is, these are conditioned by positive or negative balance of payment status of the country. Autonomous transactions are undertaken by private sector and government sector also, whereas accommodating transactions are undertaken by government sector alone. Then your autonomous transactions take place in both current and capital account, whereas your accommodating transactions are happening in only capital account. Autonomous transactions are also called above the line item, and accommodating are also called below the line item. Okay, now we are left with the last topic, that is talking about deficit and balance of payment. So disequilibrium in balance of payment is of two types: either it will be surplus or it will be deficit. See, equilibrium is when your debit and credit, everything is equal, there is balance in balance of payment, then that will be equilibrium. But disequilibrium means either one of the thing is big and the other is small. Okay, so let's see when this disequilibrium in balance of payment arises. So there can be surplus in balance of payment when your debit is less and your credit is more. Okay, so when the payment, that is debit, of the country are less than its receipt, that is credit, the balance of payment is said to be surplus balance of payment. In other words, when the inflow of foreign exchange is more than its outflow, balance of payments is in surplus or it is favorable. Now talking about deficit in balance of payments, it refers to a situation when outflow of foreign exchange is more than its inflow. That is, when outflow of foreign exchange is greater than the inflow of foreign exchange. Now let's talk about the causes of deficit in balance of payments. There are various factors which are responsible for it, like economic factors. Economic factors includes developmental activities. Developing countries depend on the developed nations for import of goods. This lead to increased level of import, thereby resulting in deficit in balance of payments account of developing countries. If dependence on developed nation reduces, deficit may reduce, right? Then we have high rate of inflation as other economic factor. When there is inflation in the domestic economy, imports become relatively cheaper. It increases imports, which causes a deficit in the balance of payment. On the other hand, if there is inflation in other country, it would reduce import from the country, leading to fall in balance of payments deficit. Then we have political factors. Political instability, policies of government, etc. are responsible for it. Political instability may lead to huge payments and reduce the receipt of foreign capital, thus creating balance of payments deficit. Then policies of government, if policies of government favor imports, there will be deficit in balance of payments. After that, we have social factors. Social factors include demonstration effect. When people of a country prefer goods made in advanced country, they start importing more of foreign goods, and it leads to an adverse balance of payment for that country. For example, most of the people are preferring iPhone, okay, and the mobile phones which are made in other countries, right? Because in our country the mobile phones are not that good and there is no much manufacturing of it. That's why people are preferring foreign good over Indian good, because it is not competing well, right? It can be one reason of why we are importing from other country, right? And this demonstration effect is just saying that people are preferring the products of advanced country in order to show themselves as advanced beings, okay, rather than that of their own country, and it is creating adverse balance of payments for the country. So rather than going for your Pepsodent and other, your Lifebuoy and other foreign companies, just adopt the Indian one, right? Which are doing their production in India only, right? And which are helping Indian economy to boost. In that way, you will be also contributing to the to your balance of payments, right? And then we have change in taste and preferences. So a favorable change in demand for domestic good in the market cause surplus balance of payment, and an unfavorable change in demand of domestic good in the international market causes deficit in balance of payment. So if you will think, you will be determined that no, I'll just use the product of my own country, then automatically there will be surplus balance of payment because we won't give more money to the foreign nations. On the other hand, if you will prefer foreign goods over Indian goods, then there will be deficit in balance of payments. That's why the government is focusing on Make in India, and then Swadeshi Apnao, right? Go local, become vocal for local, and so on. Because they have to make sure that balance of payment does not go in a huge deficit, okay? Because that will be very bad for the country, right? So in order to avoid that situation, the government is focusing on the local things. So you should also, since you are the student of economics, so it becomes your duty, whatever you are studying, apply that in your real life as well and do something to contribute for your country, right? And go for local thing rather than going for the thing that are manufactured in other country, right? So don't use Chinese product and the products of other countries. Use the products that are made in our own country, right? So that's all for this video. We are done with this chapter. Over here you can see the syllabus. Balance of payments account is done. I told you its meaning in a very detailed way. In components, right, we did components also in a very detailed way. After that, I told you the meaning of balance of payments deficit along with its causes, okay? What can cause balance of payments deficit, right? So you can see over here we are done with everything. So if you have still any confusion, please comment down below so that I can cover it in the next video, where I'll tell you about the important questions that CBSE can ask. And if you want me to continue with the series of Indian economic development also, then please tell me by commenting below. Thanks for watching. Please like, share and subscribe. Thanks a lot.